Hello and welcome to Money Matters. I'm Sarah Peterson here with Dean Greenberg and Todd Glick Jr. of Greenberg Financial Group. Hi guys.
Good morning. How you doing,
I get
Sarah?
both of you today, so double the fun.
Oh yeah, love coming on.
You know, you guys, obviously you are on the younger side to be working in this sort of financial industry, especially like focusing on financial plans, which, you know, sort of look at long-term retirement. And you guys grew up in this fabulous information age. You know, you have access to information on, you know, the internet, on social media, all these places, but there is quite a bit of false information out there. So today we're going to work on debunking all of those myths, and you guys can tell us what we should be focused on and maybe what we should kind of toss out the window. How do you feel about that?
Yeah, there's a lot going on in this world, and it's the information age on the technology gets it right at your fingertips all the time. So there's a lot of stuff, and anybody can say anything on the internet, so you don't know necessarily what the best plan of action is, and that's why we always talk about the financial plan and creating your own financial plan, because it's all unique to your own situation. It's not necessarily what you see on the internet. It's not your plan. You have different things going on in your life, and I mean, one big myth we always talk about is paying off your mortgage before retirement is the greatest idea you can do, because then you don't have a mortgage payment. But it's not necessarily always the economic side to smart to do it, because especially in the last 5 years, you might have a rate that is 2.8%, 3.4%. We might not see that again for a long time, if ever again, those low of rates. And we have now clients coming in, 6 years ago, they refinanced that, and now they just want their mortgage to be done so they don't have that payment. But that's not necessarily the smartest thing to do, because you still have money markets that are paying you 4% interest a year. So then if you're paying off your 2.75% mortgage, you're missing out on roughly 1% more gain on cash that you could have on the side.
Correct.
So there's just things to think about when you're creating your financial plan, when you're looking into retirement, what the best route to take is for your plan. And that's why you have to go through everything and every different avenue you could think of.
Yeah, it's kind of like information overload, right? And even when we're sick nowadays, we'll WebMD it or look it up on Google, and then all of a sudden we all think we have cancer.
Don't Google it. Just don't do it.
Really dangerous thing to do. But
Step
people do
away.
this, right? But people do the same thing with their finances, right? People care about their health and they care about their financial stuff. I mean, that's the things that bring most stress to most families. So they want to make sure those are covered. And one of the biggest stress for most people is paying off a mortgage. Like having that monthly cash flow every single month is really annoying. Then the idea for most people is the minute I get to pay that off, I can then use that extra money to invest more money into the markets or things like that. But what most people will fail to realize is you're really only saving the principal and the interest. You're still going to pay property taxes. You're still going to have HOA if you have things like that and other fees. And so you don't save as much as you think. It's that entire monthly payment that you're currently paying is not all principal and interest. There's other things like escrow that you're paying for. So it's not the biggest deduction that you think you're getting, and that's why a financial plan is so important. We actually have to run those numbers and see what's the actual principal and interest you're saving, and then run that into the plan, and not overdo the savings that you think you're going to have, because then you might have an unrealistic financial picture.
I think the other point is not making your financial decisions based on something emotional, because it seems like a lot of people, it's that burden of debt. It feels like it's weighing you down, but not all debt is bad debt. And in that case of 2.8% mortgage, that's good debt to have.
And the people that are wanting to pay off their mortgage now are coming from a generation that had their parents with 18% mortgage rates, with 12% mortgage rates, and that was common. Now you have people with 2% mortgage rates, 3% mortgage rates. It's a very different story, right? You can't go in the market and expect an 18% return. But you can go in the market and over a 10-year period, be pretty confident you can expect at least a 7% return. And that's largely a higher rate of return than you're getting on your interest, on your mortgage right now. So when you run the numbers over a long period of time, good debt, it makes sense not to pay off, and instead use that other money that you were going to use to pay off that debt to actually work for you in a more effective manner.
I recently saw a chart. It was so upsetting to me. From the 1950s to now, what percentage of people back in the 50s were by 30, with families owning a home versus now, what percentage of 30-year-olds own a home? It's so minuscule compared to what it used to be. And so, I mean, home prices being as high as they are and everything being so expensive, it just makes me wonder how this next generation is going to be able to make those big investments.
And it's largely because of inflation, right? I mean, over the last 50 years, really since we got off the gold standard, it's really gotten even more abundant since 1970s, where all of these houses are going sky high and people's wages are not following that same trajectory. So the only way you can really keep up is making sure you're at least keeping up with inflation. Inflation's running at 2% a year. So if you're keeping all your money in a checking account and it's not at least in a savings account earning more than that inflation rate, you're actually going to be losing purchasing power each year, meaning it's going to be harder and harder to get that home that you're trying to save for.
Yeah, nowadays, the money markets are paying you 4% interest on the annual rate. That's not always going to be the case. As the Fed lowers rates, that's going to lower as well. Like back in 2020 when rates were zero, interest rates were zero. So the money markets weren't paying you anything. So you have to take advantage of what the market gives you in the time that it does, because otherwise you're just going to sit there, like Todd was saying, is lose purchasing power when you could have at least kept up with it and exceeded it a bit. With money markets, they're safe. It's like a checking account, but they're just paying you interest so they can work your money. But for you, it's there. It's not going to fluctuate with the market volatility.
And I think what we're trying to say as well is when you get super excited and you're saying, oh, I can actually make some money on my money, don't just run to YouTube and use those resources as if, oh, I can make 100% this year. Those are unrealistic returns. When you have a long-term trajectory and you have a financial plan understanding what you're actually trying to shoot for in a realistic manner, and you stay disciplined to that plan, that's when results happen. That's when success is found. But when you try to rush things and try to get an unrealistic return in a short amount of time, that's when people lose a lot of money, and then they have this idea that the stock market's gambling and things like that.
What's a term like house rich? People think if I'm house rich, they don't have a lot of cash on the side, but they have this big fabulous home and they have nothing else to spend.
Yeah, so house rich is because they have a lot of equity in their home. Say they pay down their home mortgage, that means if they ever sell their house, they get the whole sale purchase price.
But if they don't sell it.
But they have to also, the issue you run into is somebody on the other side has to buy it, which housing market isn't always the best, or your house isn't the best on the market and nobody wants to buy it, then you have no cash, because unless you go through the different idea of a home equity loan or something like that, or you want to go down that route, but it's not necessarily house rich. You're taking a loan from yourself and you got to pay that back. But if you sell the house, then you'd have the cash, but in that sense, where you're going to live, you're going to have to use that cash to buy another house. So house rich, it means that you have a lot of equity in your house, but it's not necessarily always it's not liquid.
Yeah.
So being house rich doesn't mean you have an income coming in. You have liquid cash that you can use to go on a vacation, go to the grocery store, go pay your monthly utility bills. It's meaning that you have a lot of equity in your house, so in a sense you have some wealth there, but it's not always liquid.
Yeah, it looks great on paper, but it actually doesn't do anything when you try to go to the grocery store and buy some loaf of bread. You can't eat counter-grounded tax.
It helps your net worth. It increases your net worth because the debt on the side of the mortgage is down and your equity's up, but it doesn't help your day-to-day living.
I mean, this is stuff we do not learn in school, and I don't know why, but we really need to, because this education is invaluable. Everybody at every age and stage needs to know how to handle their finances, especially as you're getting closer to retirement, learning how to take that risk factor off and planning for all of the inevitable changes that are going to go on in your life. So if these are conversations you haven't had with your advisor, or if you have an advisor and they haven't discussed this with you, please give us a call. This is a complimentary. This is a gift that we're giving you guys for sitting there and listening to us and educating yourself. Also, there are workshops that they can attend, correct, on a quarterly basis, which is so great. Yep,
we have a workshop we're starting. It's going to be every quarter. We're doing a 2-year series with this where it's going to be interactive financial planning. So what we're going to do is you come in, we're going to hold it at La Paloma Country Club, where you come in, you have lunch with us, you have coffee, soda, whatever you want, and we will go through the financial plan interactively with whatever questions you have. We want more questions because then we can see what really is the interesting part of what you're trying to do, and we'll go through the entire scenarios of the financial plan.
So whatever is holding you back, whether it's intimidation factor, you don't want to do one-on-one, the group setting might be better for you, or if you're just dragging your feet, this is the time to just get up off that couch and make that phone call. 520-544-4909. We're going to take a quick commercial break and we'll come back and talk more about your money matters.
This is Money Matters with Dean Greenberg of the Greenberg Financial Group. I'm Spike Spangle. Dean, what really got you started in this industry?
It was because I was working for Ford Motor Company. I had ordered all the dealerships, and I kind of looked at things and I said, this is not what I want. So I went back and got my MBA in finance and investments and said, I'm going to work on Wall Street. I didn't really know the journey I was going to have until later on, 1987, when the market crashed.
Yeah. Black Monday.
Black Monday. The only person in a company of 600 and some odd brokers. I was buying IBM, and I opened a $500,000 account. So they say to me, hey, this is unbelievable. How did you do this? What did you do? I just said, because I thought it was the right thing to do. Down 20%, it was probably a good time to buy, and I was more of a technician and an advisor and an educator at that time. Long story short, they tell me a week later I never owned the stock. The back offices back then could not handle 1 billion shares a day. So a week and a half later, they tell me I don't own it, and I needed to call the client to tell them they didn't own the stock. And I told them that they should pay the client. Next day I came in, my box of stuff was in there, and they told me I was fired. And I went to go see the guy I knew to go get a job. And he said, Dean, I'd hire you tomorrow, but you need to start your own business. I laughed at him and said, how am I going to start my own business? I only have $5,000. He said, figure it out. We're all salesmen. You educate. You care about the markets. You care about your clients. So I guess I figured it out.
Hello and welcome back to Money Matters. I'm Sarah Peterson with Dylan Greenberg and Todd Glick Jr. of Greenberg Financial Group. And gentlemen, this is such a great episode because we're talking about debunking all of the myths. There's so much misinformation out there. I know for me personally, my social media feed, sometimes somebody will come in there, Dr. So-and-so, talking about some medical thing, and I'm like, what kind of doctor are you? Like, I don't think a lot of people are stopping to take the time to research. Who am I listening to? And where's this information? You know, in our generation, we called it water cooler conversation. So I'm so old, but that's what happened. You would stand by the water cooler and you'd like, some guy would say, oh yeah, you know what I'm investing in. You got to get into this, you know. I mean, how does he know what my long-term goals are? How much money I have to invest? Or like, I mean, this is not something you can listen to water cooler talk or, you know, Instagram, social media talk on.
Yeah, that's a great example because that water cooler talk has moved to YouTube, has moved to TikTok, and now we have all these people that claim to be experts in understanding what you need to be invested in, but have no understanding of actually your unique goals and objectives, what your unique risk tolerance is. And that's where a financial advisor gets involved. We're actually trying to build out a roadmap to get you to where you're trying to go most efficiently based on the risk tolerance you can handle through the day-in-day life that we are going to experience, right? The market does go up and it does go down. And there is a lot of risk that is associated with that. And when people go into an investment that they just heard on the TikTok or social media and say, I'm going to invest in this because I have a fear of missing out, and then they get burned because they lose money, they'll have this narrative in their head that the stock market is just a gambling casino. And it's much like gambling where you might win, but you might lose it all. But in reality, if you're doing investing with disciplined-like mindset, and you have a diversified portfolio over a long period of time, and we've seen this with the S&P 500 going back to the 1950s, it has averaged 10% a year through all the ups and all the downs. All the 2008 and 1987 Black Monday crashes, we have continued to have the market return 10% a year on average because the economy is going to grow. I mean, if you don't think humanity is going to continue to grow, then maybe don't bet on the stock market. But overall, what we have seen over the last 200, 300, going all the way back to human history, we'll continue to find new technological advancements that bring out more growth into the economy, that makes more money for the economy, which makes the market go even higher.
And it's a great idea if you're trying not to pick a single stock because you're just trying to get into the markets and have your money grow that way over the long term, like Todd was just saying. If you go into the indices, the S&P 500, the NASDAQ, the Dow, those three indices alone cover the broad market in the U.S. and they constantly change companies. So the S&P is the S&P 500, which is the 500 largest companies in the country. That's constantly changing, and it's all listed by market cap on how big the company is. So they will put the new 500 companies together.
It sort of seems like it's set up for success, right?
Exactly.
If one's not doing well, they're just going to take it off.
Exactly, and the Dow has 30 stocks where there's a committee that decides the 30 stocks. And then the NASDAQ 100 is the 100 largest tech companies. So they're constantly changing. So if you're in those indices, you will constantly have new companies coming in and constantly growing the markets and growing the ETFs that you're in. If you're trying to, the stock market becomes a gambling tool when you're trying to pick a penny stock where they're $1 and you're hoping to hit $100, kind of like on roulette. That's where it's considered casino, where it's considered gambling, but investing is investing in the company, like Apple. You're investing in Apple when they came out with the iPhone because you think that's the next level and that's the future. Right now, AI is the new generation, and that's why these AI companies and these AI chips are all doing very well, and the NASDAQ is all mostly tech companies, and they're doing very well, because that's where the future's going, and that's where people want their money. So we're investing in that for the next 5, 10 years. I mean, you have quantum stocks, quantum companies, which is stuff that's not even happening right now, but you're putting money to it for 5, 10 years from now because you're believing that this is the next step in our growth.
And the greatest thing about the indices is they're really cheap in terms of expense ratio. Most investors don't understand an expense ratio is something you're actually paying the fund that you're invested in an annual percentage for the right to invest with them. Mutual funds have much higher expense ratios on average than ETFs, but even passive ETFs can have even lower expense ratios than some more actively managed ETFs. And so like indices like the SPY has about a 0.11 expense ratio. It's as low as you can pretty much find. Some are 0.07. So you don't even have to pay a fund manager, but you still have this indice that is filtering the top 500 companies for you. And like I said, going back to 1950, S&P has averaged 10%. And with the rule of 72, every 7.2 years, your account would double if you average a 10% return. Now, if you keep contributing it should double even faster than that. But if you're working, the idea is have that money go down is not a problem because you're not needing it yet. So actually buying at lower prices is more beneficial than worrying about selling when you're still going to be working for a couple more years.
It's just, it does make sense to me because I like to buy things on sale. And so it's like, wait till it's on sale and buy more of it because you think it's a good investment and you think it's something that you'll keep for long term. I think it says a lot about a person if you're looking at your, what, if you were to go to Vegas and you're going to gamble, what game are you going to start with? I know for me, it's craps because that's the best odds and I can take $100 and play for 4 hours and have fun. If I may lose, I may gain, but I'm going to take that same money. That's how I feel comfortable. I'm like to play the game without actually losing. Somebody else might want to go and bet it all on blackjack one hand. That's somebody who's going to take more risk. But as we get closer to retirement, we want to pull some of that risk back. And I'm guaranteeing you that a lot of clients are coming to you, they don't even know what their risk tolerance is.
A lot of clients don't know their risk, or it's changed over the years since the last time they even looked at it. And that's why we have these tools that can do your risk tolerance. We can take your current portfolio, and if you have mutual funds, we can tell you what the tax drag is on it, what the expense ratio is for your composite portfolio. So we can just tell you that and see if there's anything we can do to make it more efficient in that sense.
Yeah, I mean, the risk tolerance questionnaire is great because, like you're saying, Sarah, if you're going to the casino, some people are going to be very likely to bet that 50-50 chance, and some just want the certain return. And that's exactly what the risk tolerance does. It asks you a whole bunch of hybrid questions of when do you like the 50-50 game and when do you like the certain return. And how you answer those questions, it comes out with a risk number of 1 to 100, and then based on that risk number, we'll compare it to your actual current portfolio and see how much it aligns. Obviously, if your risk tolerance is way higher than your current portfolio, then maybe we should make your portfolio a little more aggressive, and vice versa. But we also can run your current portfolio through stress tests, like what happens if we go through another 2008 with your current holdings? How much money would you lose? If you're worried, now's the time when markets are at all-time highs to look at your portfolio and see, is it time to de-risk now? You don't want to do it when the markets are at all-time lows or have just come off a 25% off the all-time highs. You want to do it when we're at these all-time highs. That's the chance to then lock in some of those gains.
And if these are conversations, I mean, perhaps they have a financial advisor they've been working with, but they're really focused on accumulation. It's a different conversation to have. If you don't have a financial plan that's going to take you through all these phases of life, this is really what you need to be focused on to make sure you're on the right track to where you want to be for retirement. I mean, we all work so hard to make the money so that someday we can stop and smell the roses and hopefully the money won't run out. So that phone number is 520-544-4909, or there's a QR code on the bottom of the screen. We'll take a quick commercial break and we'll be back with more of Your Money Matters.
Good morning, Ben.
Good morning, Ben. Hey, birthday party for Carol and 5. Happy Happy birthday to you.
Good morning, Ben. Happy Monday.
Daryl's birthday, be there every square. Happy birthday to you.
You can see from our quarterly report on slide number 62, we're trending in the right direction. All signs point to a very positive outlook for the next several years. If you peel back the onion...
Ben, do you have anything to add?
The work never seems to end until the day it finally does. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Hello and welcome back to Money Matters. I'm Sarah Peterson here with Dylan Greenberg and Todd Glick Jr. of Greenberg Financial Group, and we're debunking myths. I got all the words in my head. We're debunking all these myths because there are so many pieces of misinformation floating out in the universe. As you were saying before the break, you don't want to like self-diagnose yourself when you are looking at something medical. And same thing with our financial health. I don't know why people feel the need to take advice from someone who doesn't know how much money they have, how they want to invest it, what their goals are. I mean, this is a completely individualized plan that's made for us, not something that you can just create watching something on social media.
It is, and I mean, for a long time, it's because the financial plan the myth was that it is for the ultra wealthy. It's for the people who have a family office, that they have all these trusts and everything going around with it, so it has to be, it's not for just a normal person with a 401k where they're like, okay, I'll just talk to my friend at the water station because I don't have a family office, I don't have that, and it costs a lot of money to do these financial plans. I don't want to spend $3,000, $4,000, $5,000 on a financial plan.
Right.
We offer it for free because we believe that the financial plan isn't the luxury, it's your life. You deserve a financial plan. You deserve to know how you want to retire, not just the ultra wealthy retire. You're going to retire somehow. You're going to retire, I'm going to retire, you're going to retire, and we all want to know what the best way to retire is. And that's why we offer our plan for free, because we're just here to help you find your best path to retirement and how you want to enjoy it. And that's why we're offering that workshop every quarter, because if you don't want to come in and meet with us where you have to get everything together and it might take a while, you don't think you're ready, but you are interested, then come to our workshop. We're holding this first one in the next couple weeks, and we'll keep going every quarter for the next few years, because we find that it's very beneficial, and it might be less daunting in the sense that you can ask questions, but you're just seeing what we're all about. You get to meet us, you get to ask questions, you don't have to have everything ready, you get lunch, you get some coffee, and then we're here, and you get to meet, and if you like us, then we can set up the meeting, and we can do the whole plan from there.
And to that point, financial literacy in this country, like the education, is absolutely terrible. And it's probably better in this country than anywhere else in the world, because most people just don't understand the resources that they have available to them. We're not taught how to balance a budget, how to balance a bank account anymore, all right? Most people don't know how to file their own taxes. Most people don't know what a Roth or an IRA is, what's a 401k, how to invest in stocks, what even a stock is. And that's really because of our education system. So what our job is as financial advisors is not only be your financial therapist and help you, hold your hand through the really tough times, but is to educate you, actually help you understand the system and what's going on. Because a lot of times people don't understand, why do I keep losing money? Why does it feel like I can't buy the same things year over year? Well, it's because of inflation, right? But most people don't understand, where does inflation come from? Well, it's because they print money. Right? There's things that it's just hard to understand if no one was ever teaching you these things. And that's where a financial advisor comes in as well. We're trying to be that educator for you. That's also why we've been doing these TV shows. That's why we're doing the interactive financial workshop. But also, it's why we do our radio show. I mean, Dean's been doing the radio show for over 30 years in Tucson, Arizona. It's on KNST 790. If you ever want to listen to it, it's on Sunday mornings, 8 a.m. to 10 a.m. We also always have those recordings on our podcast station as well. So if you go to our website, greenbergfinancial.com, in the top left corner, you're going to see a radio icon. You can click on it, and you're going to see all of our podcasts that we've ever done. You can also go to our YouTube page to see our weekly market updates. We are here to help you, educate you, and help you understand this complex system.
Well, you were making such a good point, too, that our education is so poor on financial literacy in this country, but also this country, more than any other in the world, has the most tools in our toolbox. We have control over those things, which is such a wonderful thing. But in order to make the best use out of that, we need someone to guide us. In other nations where they have more socialist economies, they don't have control over their finances the way we do. They're paying 50 or 60% in taxes so that they can have good educational systems and things like that. So we are giving the control back to ourselves, which is wonderful. But it's a slippery slope if you don't know how to use it.
And that's why we talk about all the time. If you're 40 or under, don't plan on Social Security being your lifeline of your retirement pension. You have to build your own pension, and that's why these tools that we're talking about, Roth IRA, now a lot of companies have Roth 401ks, or if you do a traditional 401k, traditional IRA, those are your own pensions that you're building, because then you'll be able to take money from that and generate income in your retirement, just like Social Security, but it's something that you have in your control. You can put as much as you want in there. You can get it going for your retirement on how to work it, and you're not relying on a government that keeps saying Social Security is broken and Social Security is broke and everything like that. So it's a great thing, but you have to learn it. You have to educate, and that's why we're here to do that.
I think what you guys do so well is taking a little bit of that intimidation factor off the table. I think if somebody's sitting there and thinking, we already discussed, you have enough. Whatever you have is enough. And unless you have maybe even the more you need a financial plan to make sure that there is something left at the end of the day. So don't undersell yourself to think, I'm not worthy. You are worthy. And, my daughter is going off to college soon, and I noticed such a similarity. It's like, you have to make a plan. Look at your college application. Don't get overwhelmed by it. Make a plan. Check off the list.
I just had a call with a client's daughter that was in college right now and wanted to put a budget together, understand how much do I have to do each month. So we don't have account minimums. We have accounts with grandkids.
That's so great.
We help every single person. So if you fail to plan, you plan to fail. And understand that we're helping you plan for absolutely free.
I can't see any downside from starting young and knowing more, right? It's like, get all the information you can at a young age so that you avoid making a lot of the mistakes that we made because we didn't have that education. And there's also lunch and coffee, right? So
exactly.
You don't know what you don't know, right?
Listen, this is a gift that we're giving you for spending time to educate yourself with us. I think this is something every single person needs to visit at some point in their lives, and why not do it now while the sun is shining? Make sure you're on the right path to where you want to be on your retirement, because your money really does matter. So there's a number at the bottom of the screen, 520-544-4909. You can also scan that nifty little QR code, whether you come into the office, visit with Dean, Dylan, Todd, or you come into one of their quarterly workshops. You can go to greenbergfinancial.com and get that information about when those workshops are. You can get an education like no other, and why not? It's complimentary, and there's lunch. It's something we should all do for ourselves. We need to stop. We'd rather sit and talk about our vacation that we're having next week than how to get there, right? And this is, we have to shift the mindset. So thank you so much for sitting with us, and thank you for taking the time to learn about Your Money Matters. We hope you'll join us on the next one. We'll see you soon.